And we shall see, there are 3 pages in the Rio Tinto financial statements that we'll look at. Typically, historically, taxable income started with the financial statements, and then there were significant changes made to those statements in terms of how you calculate taxable income. Fairly typically, the depreciation or amortization of assets was done differently for tax purposes and for financial accounting purposes. And there were a variety of other changes as well made in order to determine taxable income. Recently, the OECD has begun to look at financial statements as the actual basis for taxation. The proposals do make some adjustments to get to the taxable income amounts, but the basic reference point are the financial statements themselves. And that's true in the United States as well, with respect to a new minimum tax provision. So financial accounting is of increasing importance, not just as the bedrock for taxable calculations, but also that's directly the reference point for those calculations. Okay, let's go to the next slide, please. Okay, what are we going to look at in financial statements? Well, things are pretty simple to begin with. You just look at profit before tax, and then the tax figure usually in most financial statements follows directly below that. But it's an income tax figure. There are all kinds of other taxes that companies pay, and these other taxes are referred to as above the line tax expenses. So you may not even see them. Typically, they are subsumed in other expense categories. But in any event, the figure that we're worried about today, for the most part, is income taxes, and that typically follows right after the pre-tax figure on the face of the financial statements. Then in the balance sheet, we have further disclosure. Current taxes payable, that means the liability that's outstanding. Now, if taxes are paid during the year, you won't see those on the balance sheet. They've already been paid and disposed of. And then you'll see also something called deferred taxes. And deferred taxes are taxes where the calculation of taxable income in a jurisdiction is done on a slightly different basis than the calculation of financial statement income. So that means that taxes are either paid before the relevant amount of income is reported, or they're paid after the relevant amount of income taxes is paid. And if they're paid before, that creates something called a deferred tax asset. If they're paid afterwards, it creates a deferred tax liability. And then finally, there's a tax footnote. Frequently, there are 2 tax footnotes. As we will see in Rio Tinto's financial statements, there's one just on the tax calculation, 1 footnote, and another footnote that deals with deferred taxes. Okay, let's move to slide 4 if we could. When we talk about differences between financial accounting income and taxable income, we refer to them as permanent differences and timing differences. Permanent differences are taxes that will never be paid. And there may be reasons for that. There may be a tax holiday in a country. So as we've discussed already, many jurisdictions, when they enter into an agreement with a mining company to engage in business in a jurisdiction, they may, pursuant to a contract, grant the mining company a tax holiday, meaning the mining company doesn't pay any income taxes for a period of time, and they will never have to pay those taxes. So that's a permanent difference, and it represents one form of permanent difference. There are a variety of other permanent differences, some kinds of tax credits. For example, many countries offer research type credits, and those credits also result in a permanent difference in that the taxes that would have otherwise been paid will never be paid. The next category I refer to as quasi-permanent. To be honest, that's not a term in the formal accounting literature, but it does apply in a few instances where the treatment of an item is permanent until the company does something different. And the most notable one of these in the United States and elsewhere in the world, to be honest, is where there are profits earned outside of the jurisdiction of the resident corporation, the parent corporation, and those profits are invested in a relatively permanent fashion. Those earnings on those particular profits are reinvested overseas, are not subject frequently to taxation in the home country, and won't be subject until they are brought home sometime far in the future. And some jurisdictions then treat those profits as not taxable, resulting in sort of a permanent treatment of those in financial statement purposes. So they're treated as permanent differences until the company decides to repatriate the profits home. So that's an example of quasi-permanent. There are very few of those things around at this point in time, to be honest. Timing differences I talked about before. And I won't repeat what I said before. It's useful to spend just a minute on deferred taxes, and that a lot of people know what they are and talk about them. But I think the economic significance of them is worthy of a few seconds of time. In any event, deferred tax liabilities, which many companies create and really is a subject and an object of some of their tax planning, in effect, that is a form of financing of the business. It's a liability that hasn't been paid, doesn't have to be paid until it so-called reverses in time. And so just like any other liability, it is a source of funding for the business. Conversely, a deferred tax asset, which is a prepayment of a tax, is a burden on the business. And it is a cost-bearing asset, just like any other asset that's put on the balance sheet. So it's kind of easy to say deferred tax assets and liabilities and not focus on their significance, but they do have an economic significance that's worth paying some attention to. Okay, on to slide 5, please. If folks have questions or comments as I move along, please share them with the group. All right, we're going to talk about consolidated financial statements here versus the statements of subsidiaries. I think for the most part, the people on the participants in this course will see the financial statements in their local jurisdictions, which will be the statements of subsidiaries. And they're considerably different than the consolidated statements of the parent company. So the parent company has not only the statements of what it does in its resident jurisdiction, but it also picks up and consolidates the statements of all of its subsidiaries worldwide. And the statements of the subsidiaries are just for the operations that that particular subsidiary has. Typically, the subsidiary operates only in one country, although in some cases the subsidiaries are large and also operate in multiple different jurisdictions. And their income is determined subject to the transfer pricing that Michael talked about yesterday. So the transfer pricing isn't just an artificial effect, it's reflected on the accounts of the subsidiary. And the subsidiary's accounts are the accounts that the taxable income in the local jurisdiction is based on. Now that can change under some forms of formulary apportionment. And indeed, when one looks at the OECD proposals for Pillar 1 and Pillar 2 and the consolidated use of financial statements, one of the reasons for the use of the financial statements is to try to get around the artificiality sometimes of what the subsidiary financial accounts look like. So putting it differently, the proponents of Pillar 1, for example, did not like the transfer pricing rules, at least with respect to Pillar 1, and use consolidated financial statements of the entire entity and not looking at subsidiary accounts. Okay, let's move on to slide 6. I'm going to talk about Rio Tinto's financial statements with these slides, and then we're actually going to pick up 3 pages of the financial statements and look at them as they appear in the rather massive report that I could not manage to send around to you folks. In any event, Rio Tinto, as most of you know, is a very large mining company. It has its biggest operations are in Australia, but it also has operations, I don't know, in many, many different countries around the world. It makes a lot of money, so it's one of the bigger companies that you'll see in the mining industry. Some of the oil and gas, petroleum companies are bigger, but in terms of mining companies, it's a very large company. Its profit before tax was 30 billion or 30,833 million in US dollar terms. It paid 8,258 in taxes, and so its effective tax rate, just doing the math, is 27.5%. I will say, just to put that in perspective, that's a fairly common figure for mining companies and oil and gas companies. Some of the high-tech companies have effective tax rates, or at least did historically in the last decade or so, of much lower effective tax rates. Some of them as low as below 10%. And so you can see there can be extraordinary differences in the amount of taxes that these different companies are paying. And one of the reasons that BEPS became a project was that the effective tax rates of some of these large multinational companies were so low, and countries looking at those effective tax rates said, wait a minute, these companies are not paying their fair share of tax. We'll look at 2 footnotes. Footnote 9.
Excuse me, John. Could you say a little bit more about the reason why, even though there's a good deal of tax planning in the extractive industry sector, the effective tax rates are considerably higher than those, as you mentioned, in the high-tech industry? Well, what do you think is the main cause of that difference?
Well, I suspect it is that they don't have flexibility in where they're reporting their income. if you run a mine, you can't really move the mine to a tax haven. And the high-tech companies, what they would do is move intellectual property, patents, and so-called know-how. And they would attribute these forms of intellectual property, not attribute them, but they would legally have them recorded in a tax haven. And then their operating subsidiaries would pay royalties that were deducted locally into the tax haven. The result of which was that you'd reduce the taxable income in the operating company's jurisdiction and increase it in the tax haven. And the tax haven frequently had no or very low tax rate. Mining companies did some of that, but the basis of their operations are mining or oil and gas production. And so you couldn't really move those type of assets to a tax haven. So I don't know, maybe you can expand on that, Michael, but I think that's the basic reason.
Yeah, I mean, extractive industries companies obviously do some income shifting by undervaluing or arguably undervaluing the product that we were discussing yesterday. But high-tech companies have much greater opportunities to set up intangibles holding companies, as John was just saying, in tax havens and shift a good deal of income to them. And although tax avoidance in the extractive industries is still important, it's not as marked as it is in the high-tech industry, but still a great deal of revenues are at stake in the extractive sector.
Yeah, I think in fairness, the tax issues in extractive industries focus on transfer pricing of the product, which can be very, very difficult to say the least, but it's a different kind of tax planning than moving so-called valuable intellectual property to the Bahamas or something of that nature.
Mm-hmm.
Okay, let's move on to slide 7. I think at this point, Warida, if you can pull up, I sent you a file with 3 different items in it. And if you can open that file and put up Rio Tinto's income statement, that would be great if you can find it. There we go. Okay. We're not going to spend a lot of time in this since, first of all, it's hard to see. Let me put on my glasses. But this is just illustrative. I already gave you the figures. Well, we've got the wrong. This is the deferred tax asset. Well, we can start with this and then we can go to the next slide. But this is actually footnote 17, and it's giving you the deferred tax account. So this is one of the pages of the footnote. This is actually from their financial statements for 2021. And when you look at it, you can see what the deferred tax assets are above the line there. The biggest thing is provisions. What does that mean? That's left to the viewer to decide, I think. But in any event, what it means, I'm almost certain, is that they're not certain of the what the amounts are going to be. They've done some tax planning or whatever the situation is, and they've had to they've recorded a liability, but they're not sure whether they're going to have to pay it. When deferred tax liabilities, the biggest item you see there is a capital allowance, which really means depreciation So you get a sense of the size of this. Rio Tinto is a big company. So you're looking at pretty large figures there. You know, there are a lot of zeros that are missing on these accounts. Okay, so that's footnote 17, deferred tax accounting. Put up another page if you would, Rita, please.
I've just noticed that was a middle page. I'm putting up page 212 right now.
Yeah, okay. Are you able to find the other two pages in the same here we go. Okay, let's see. Well, this is the income statement, gives you a sense of it. And we don't have to spend a lot of time here, but you can see the figures. It just gives you a sense of how these things look. They're very, you know, everything's reduced to just a few lines here, which doesn't tell you very much. If you're a tax inspector and you're trying to look at this and figure out what's going on, you don't get a lot of detail. But in any event, the profit before tax, which is partway down the page, is 30,833,000,000, and then right below it is the tax amount. Okay, let's put up the last slide, if you could, from this group, Rita, please. Okay, this is footnote 9, and this is trying to tell you a little bit more. Let's see if we have the right slide. Not sure that's the correct slide. Yeah. Let's see. I know why you're struggling, Wade. I think I sent you a separate file. In any event, page 247, if you're on the financial statements themselves. Okay, that's it. If you can increase the size of that just a little bit. Now, this is the footnote 9. And frankly, this gives you a fair amount of detail about what the company is trying to tell you about their tax planning and what's affected their tax rate and how much tax they're paying. And here, because it's consolidated, meaning all of the subsidiaries around the world, it's not telling you anything jurisdiction by jurisdiction. But at least with substantial subsidiaries, you'll find similar information for them. And so, frankly, if you want to understand what a company's doing, tax planning wise, or it may not even involve tax planning, just may be involved whatever the jurisdiction providing in the form of tax benefits, you need to go to a page like this and get into the details, because what you see is that you get differences from what you anticipate the taxable amount would be. And so that the anticipated amount here is the top two lines there, which says prima facie. tax payable at the UK tax rate. Why the UK tax rate? Because that's where Rio Tinto's incorporated. It's the parent jurisdiction. And then they provide a second line there in the Australian tax rate because they have a huge amount of operations in Australia. So they're saying, you know, if all we did was multiply our pre-tax income by the effective tax rates in those two jurisdictions, that's the amount of tax we would pay. And then we had some adjustments. And frankly, with Rio Tinto, the adjustments aren't all that large. You can see that they are relatively modest in amount. There's an exchange gain or loss on derivatives. Frankly, that means their foreign exchange gain or loss for whatever reason isn't subject to tax. And so they're doing that. But in Rio Tinto's case, they aren't significant. If you get into some of the technology companies, you'll see very, very significant differences in a page like this. So in any event, this is the reconciliation of the statutory tax rate to the actual rate of tax being paid by the company. Okay, I think we've looked enough at that. We're going to go back to the slide deck. If you could, Warida, please. And we should be on slide 7 on the slide deck. Many governments got very frustrated with companies obscuring what they were doing, and the tax authorities could not figure out what they were doing by looking at their financial statements. They were looking at the things that we just looked at and did not find that they were very helpful in determining actually what practices the companies were undertaking with respect to their tax planning. And so they required many different jurisdictions, then said, well, we need some help with this. We're going to put the burden on the companies themselves to disclose to us what they are doing in more detail and in a fashion that we can understand. At least that's the hope for behind these rules and regulations and laws. And so in the UK is interesting in this regard. They require companies, large companies, not all companies, but significant size companies, to disclose their tax strategy. And they need to make not only the tax strategy public to the tax authorities, but public to the world. And UK-based companies have to disclose everything they do around the world in their tax strategy disclosures. Companies that only have subsidiaries in the UK, but nevertheless large businesses there, only have to disclose what they're doing in the UK. Some of those companies, even though they're not headquartered in the UK, decide to disclose their tax strategy for the world as well. So we're going to look at Rio Tinto's UK disclosure statement. It's quite fascinating. Rio Tinto is not a company that it's a member of something called the B team, which holds itself out as paying their correct amount of tax, and they are fairly proud of it, to be honest. So this is their disclosure document. We're going to leaf through it. There's 3 pages I wanted to look at, but it's kind of useful to just go. There it is. Yeah, that's the 3 pages I wanted to focus on. And suddenly you get a sense of the detail of what they are disclosing in this statement. And so maybe you can bring that up a little bit. The companies that make these disclosures they want to tell you not just the income tax, which is the subject of this course, but everything else they're paying in the form of taxes. You know, they don't want it to sound like all they're paying is income taxes. So they tell you everything they're paying. And so this is kind of fascinating to look at. So the far left column, you can see it's corporate income tax. What is government royalty? Well, government royalties are, they're clearly not taxes, but one could view them as a form of funding for the government. So the royalties are what we talked about yesterday. You know, these are the amount of payments that go to the government, not as taxes, but as pre-tax royalties. So they're showing you that. They're showing, I'm not quite sure what fees and dividends, and those are probably withholding taxes, but then they tell you the payroll taxes they're paying, so on and so forth. So they're trying to tell you we pay not only corporate taxes, but we pay a variety of other taxes. And why don't we just scroll briefly down the page, Wahida, if you can. They're going to give you this disclosure. Keep going if you would. They tell you for all the countries that they are engaged in business in. Okay, that's far enough. But it's an interesting set of disclosures, and actually a fairly useful document, interesting document to look at. Okay, let's go back to the slide deck and we'll finish in just a few minutes. Okay, so this is what the requirement that the UK imposes. Yeah, let's go to the next slide if we could, please. Okay, this slide tells you what the law in the UK is about what you have to disclose. And, you know, this is sort of general type of stuff, but in any event, it's what the law requires. And it's kind of interesting in and of itself. Okay, let's go on to the next slide. All right, the B team is a group of companies that have said that we want to be ethical about not just tax, but a whole variety of things that we do. We're proud of what we do in terms of how we conduct our business. And so we've articulated some responsible tax principles. To be honest, I think a lot of these principles have sort of been, I wouldn't call it superseded, but the BEPS project by the OECD Inclusive Framework has kind of seized upon these things and kind of put them into law, even though a lot of them were already in the law. But, you know, it's kind of interesting to look at tax strategies approved by the board. I will tell you, having worked in-house at several large corporations and advised other large corporations, most boards spend very, very little time, if any, on tax. They just don't do it. They'll talk about it when the CFO reports on their financial accounts for the quarter or for the year, but it is extremely unusual for the board of a large company to spend time on a tax strategy. So that's kind of an interesting item. Compliance is what you'd expect. Corporate structure, many companies are reluctant to tell much about their corporate structure, particularly if they're using tax havens. And the balance of this, frankly, is pretty straightforward. So we're not going to spend more time on that. Let's go on to the next slide. Okay, management accounting. A lot of people, first of all, they may not know much about management accounting. And almost universally think it's somewhat irrelevant. And I happen to be a person who disagrees with that. To begin with, if you've worked inside a company, you know that management of a company drives corporate behavior. It absolutely is how the company is managed. In big companies, you cannot sit there and direct all the employees around the world. It's virtually impossible. But you can set out your goals, and they are articulated ultimately in management accounting. You know, how much money do you want to make in this business segment? How much of an expenditure do you want to make in this area? All those things are the subject of management accounting. And if you want to know what the relevant business segments of a company are, just look at the management accounts. You know, I find it somewhat humorous when people say, well, how do we determine what a business segment is? Well, it may be hard to do it for all of the companies around the world or all the companies in a particular industry. But for any particular company, if you want to know what the business segments are, just look at their management accounts and it will just be straightforward. The management accounts are based in business segments. Usually they start with legal entities. Sometimes they cross over legal entities and consolidate up across many different legal entities, but they drive how business is frankly run. And so let's move on to the last slide if we could. You want to know what transfer pricing does? Look at the management accounts. You know, they're going to reflect the transfer pricing. And sometimes the transfer pricing is the same for tax as it is for management accounting, but not always the same. And so if you want to know what maybe it should be, if you're really interested in making adjustments, if you're a tax authority, look at the management accounts. For example, the funding for a business on a legal entity basis, the interest that's charged, the rate of interest that's charged may be vastly different than it is for management accounting. And so you say to yourself, well, why is that? What's the justification for that? And I will say that most companies fight tenaciously to avoid showing their management accounts to tax authorities. For a variety of reasons, but for many of the reasons I've just been talking about. And then an interesting question is, are the businesses being run on an after-tax basis? And if you want to have businesses focus on tax planning, you say to them, we are going to judge your results after tax, and their interest immediately increases on what kind of tax planning the company wants to undertake. So that in and of itself is kind of an interesting question. So management accounts, even though they're often overlooked, are a significant source of information to people, particularly to tax authorities or to outside advisors. I think the last slide is simply references. And that's it. We have a minute or two, so I'd be happy to answer questions that people have, if they have any. Anybody a question, comment? Michael, any thoughts of yours? If not, we're
well, just an observation that you know, management accounting, the accounting principles by which a company manages its business involves transfer prices that are very different from the arm's length transfer prices. For example, for management accounting purposes, when when one subsidiary sells property, good raw materials, for example, to another subsidiary, the management accounting typically accounts for that transfer at cost without any kind of markup, because that's the transferring raw materials and intermediate goods at cost is the most economically sensible way to manage a business. Whereas legal entity accounting is supposed to use arm's length pricing. And the difference between management accounting and legal entity accounting, tax accounting, is a major source of confusion in trying to come up with arm's length transfer prices.
Yeah, it's fascinating because at some point the two accounts need to reconcile. At some level, some degree of consolidation, you're going to get the same figure, or if you don't, you have a significant problem in what you're doing. So that's what makes it interesting, because ultimately you have the same amount of income at some level of consolidation. So it's kind of fascinating to look at. The same thing is probably true of royalties. The royalties that are paid on intangible property, for example, tend to disappear in management accounting, but obviously the amounts involved, while they net out, at some point have to be reconciled. So that's what makes it interesting, and why I think it's kind of interesting to look at management accounts. You get a good sense of what the business is doing and how much money it's making. And you kind of wonder if it's reporting X amount on a management account for its business segment, where is that money being reported for tax purposes? And why is it being reported where it's being reported? In any event, fascinating subject. Okay. Charlene, I think it's time for you.
Hello.
We have a hand raised.
Oh, we have a hand raised. Oh, okay. Yeah, by all means. I'm not sure who it is.
Hello. Thank you very much. Yeah, I really enjoyed the presentation. I just want to share my experience when I was working in the authority. Some of the challenges that we do face. You'd find when you're auditing, you are looking at two things. Number one, you're looking at the sales, where we are sort of like to see if they were not underestimated, and also for cost to see if they were not overstated. So you'd find that one of the challenges that we face, we had a strong tax background, but we were not good at the pricing of the product, of the minerals, or how they are valued. So you'd find even if you are given the financial statements, sometimes you could just look at them because you don't have much information, much appreciation of the valuation of those minerals. So I really appreciate what they are doing now, like Zimbabwe Revenue Authority. They are now sort of like employing those people who are specialists within the extractive sector. Then they will train them to be auditors, so that when they audit them, maybe they would come maybe with a better understanding. Then also in terms of costing, like exactly what you are saying in terms of management accounting, definitely these two are different. You know, the way you calculate your profit for tax purposes and the profit for normal business is totally different. So you do have to add back a lot of things. For example, in Zimbabwe, we have special allowances that are given to the mining sector, which are different from other sectors. Actually, we do have when you are being trained to be a tax officer, you are taught about the mining sector, a separate module just to do with the extractive sector. So all I wanted to say is one of the challenges that we had in terms of the costing, again, like I told you, we don't have a deep understanding of the extractive sector. So it was more like of guesswork, but however, through trainings, we were getting better and better with the time. So I wanted just to come in and say, even I think it's common in most of the countries that the way the profit for tax purposes and for managerial purpose treated is totally totally different. Then in terms of transfer pricing, that one is a huge problem. Normally you don't get disaggregated data. You get data that is sort of like combined, if you request information like for separate accounts, let's say they are subsidiaries, it's quite a mammoth task. So that's what I wanted just to to comment. Thank you very much.
Okay, Laurie, thank you for your comment. Okay, why don't we go on, Charlene? I think it's time for you to take the stage, so to speak.
John, can you just confirm that you can hear me?
I can hear you. You're a little
Okay.
fuzzy looking, but I can hear you. Why don't you go ahead? I know you have some slides, so.
Just sharing my screen.
Okay.
Is my screen up? Is the screen up? Can someone
Yeah, your
confirm?
screen's up. You may want to expand the slide a little bit if you can. If you can, it's okay. There you go. That's good. Great. Perfect.
Okay. So just an outline of what we'll be looking at. I think always when we're looking at tax, it's important to understand where tax fits into the whole legal system. I will be coming at tax from a more legal slant than I think John came from an accounting perspective. So let's look at why does tax and accounting differ and how that fits into the tax system is, and then we'll dive into tax and the mining company in the second session with the worked example. So tax ultimately is a means of funding a government. Fiscal policy, which is the main policy usually determined by a treasury function within government, will determine the level and composition of government spending, including taxation and borrowing. The political allocation of those funds is what we call a budget. And a budget deficit, which most countries would have, is the difference between what the government spends and its revenue. The deficit that we can fund either by government bonds or other forms of debt. We would have seen in the COVID pandemic, during those two very intense years, many governments issued COVID bonds, and the bonds were intended to cover this gap. So fiscal policy, as I mentioned, determines government revenue. That includes income from property, which is negligible in the modern context, but tax revenues are an important source of government income, and to the extent that you can effectively raise tax revenue, you can reduce the borrowing in global markets that any particular government has to do. Here, when we talk about tax revenue at the fiscal policy level, we take a broad definition of tax. So you would have taxes proper, like income tax and personal income tax, but you would also take rates and taxes from a property perspective, even at the municipal or the local government level, and duties on property. Tax, I think it's important to remember that tax is sort of a meeting place for three very important aspects: economics, accounting, and law. I think the accounting side is quite clear from what you've heard already. Then you have the legal side, which is a bit more what I will be looking at. And when you're designing fiscal policy, of course, you have the economic side that determines, where the taxpayer appetite is, and at what point you'll start losing taxpayers at a macro level. What is good for the economy? So there are a number of tax systems. The hallmarks of any good tax system were determined initially by a man called Adam Smith, who was one of the big proponents of income tax. And you have here the 4 principles that underscore a good tax system. I think we all understand tax as a contract between state and citizen, or loosely what we would call the social contract between government and its citizens. Tax has to have an element of equality. Every person should contribute proportionately to the revenue that they enjoy under the protection of the state. Tax has to be economical. Both has to take and keep out of the pockets of people as little as possible, over and above what it brings into the public treasury of states. It's an important principle that there has to be a form of balance between what gets taken as tax revenue and what is needed by the state. It has to be convenient. It has to be levied at a point in time where the taxpayer can actually pay the tax. And here you'll often hear taxpayers talk about difference between a wet tax and a dry tax. A dry tax is a tax that is paid without any income being realized. I think a good example of that would be a wealth tax that has been bandied about of late. Essentially, it's a single tax that is paid by people above a certain wealth status, that is paid on the combined value of their assets, but essentially they don't realize any income to pay the tax with, so it's a dry tax. Tax has to be certain. I think this is something that from an African perspective, across the continent, in most of the jurisdictions, there is a lot of uncertainty how to apply the tax, when to apply the tax. So tax has to be certain as to the time that you will pay, the amount that you will pay, the quantum that you will pay, and has to be clear and concise. This links later on to a slide around tax planning, and you'll see how big an influence the certainty of a tax system has on the decisions to invest in a country. The modern tax system, of course, these principles have been reduced slightly, and so you have an element of neutrality. So in a complex capitalistic environment, you cannot have tax decisions influenced by tax at the consumer level. So if you impose a tax, especially corporate tax, and you make the pricing of a product in a particular industry more expensive because of the tax involved in relation to that industry, you may influence consumer decision making. The biggest example of taxes that distort neutrality are, of course, excise taxes and duties. Tax has to, again, the principle of equality. Modern tax systems have two principles. People who are taxed, or legal people, or legal subjects that are taxed, have to have the ability to pay, and there must be a benefit. Tax has to be administratively simple. There is the compliance cost, which is borne by the taxpayer. And in the context of increasing tax burden around transfer pricing and the BEPS and OECD workings, there is an increase in compliance, specifically at the high echelons of the taxpayers. Preparing country by country reports, having transfer pricing studies done, those are very, very expensive exercises. And I think even though we may sometimes regard taxpayers as cowboys in the wild, wild west, when it comes to transfer pricing, I think we also have to remember that no well-run business essentially tries to escape the law, but compliance can often be very, very expensive, much more than the actual tax risk that the entity may face in the event of an audit. So there has to be a balance. We can't over-engineer compliance so the taxpayers essentially just walk away, but we also have to be sure that the revenue authorities get the right information in the right and usable format. Also have the administration costs, or the costs of running the actual revenue authority. So understanding a tax system, there are 4 key pillars that I like to look at. What are we taxing? Who are we taxing? When do we tax? And how do we tax? So even in the context of corporate income tax, these are quite important principles to remember when looking at any specific scenario. So the what is what we refer to as the tax base. So this is the income, consumption taxes, wealth taxes, gifts and inheritance. All of these things might be taxed, and that is what essentially forms the tax base. Who is the taxpayer? This is a legally determined concept. So I think not particularly relevant in outside of the US, but I think in the US you essentially have a check the box system where you can elect for certain taxpayers to be fiscally transparent. And so you have a legal definition saying, even though this corporate entity is the same as this corporate entity, for legal reasons, we're going to regard them as one. The taxpayer is also has to be distinguished from the person who bears the real incidence of tax. I think there's a quite important principle to remember that, we may be taxing a corporate entity in the middle, but if you think about the real incidence of tax and where it manifests in the economy, when we talk about income taxes and corporate taxes specifically, it's often the property sector. So we have to bear in mind that the economic cost of tax doesn't necessarily stop at the entity or the legal subject that is taxed. When is quite obvious, the timing of the tax. Corporate taxes are often paid in the same rhythm that you would pay, that you would have for financial years. So you would have a financial reporting period and some legally defined period after that. You would have to report on your taxes that financial period. How do you pay the tax? Is it a self-administered system, or is it an audited system or a checked system? So maybe just to take a look at where in the spider diagram of tax policy does corporate tax sit. So you have two elements to taxes. You have domestic taxes, which focus just within the country's borders, and then you have the international element where we move across borders, which is specifically important in the extractive industries. Domestic taxes are again subdivided into two categories. You have direct and indirect taxes. Direct tax is a tax on the legal person or the legal entity, and best examples of those are income taxes and wealth taxes. Income tax, corporate tax is a form of income tax. You tax a company, and so corporate tax sits at that level. It's a direct tax on the company. Indirect taxes are more transactional based, so you tax a transaction between legal subjects. Goods and services taxes or value-added taxes, customs, excise duties, and stamp taxes are all indirect taxes. On the international tax front, most jurisdictions can only tax what is within their defined legal borders to tax, not necessarily the physical border, but the legal border. And to mitigate instances where an entity might be required to pay taxes in two different jurisdictions, you would have double tax agreements that regulate the relationship, because it is in the modern world of the global economy. I think if each and every multinational was to bear the full brunt of corporate income tax in every jurisdiction in which it operates, that's going to be quite expensive and might increase the cost of business such that you just don't see expansion, which is not ideal. You can have further classification of taxes, which is not particularly relevant in the context of corporate tax, but I just showed them on screen. So you can have a general or selective tax. Taxes can be proportional, regressive, or progressive. Proportional tax goes back to that element of balance. Each person must pay what they can. A regressive tax, goods and services taxes are a good example. You would impose goods and services taxes on goods that are open freely or freely available to consumers in the market, and whether you are rich or poor, you pay the same. You pay the same GST. A progressive tax is usually personal income taxes are progressive. So if you're on the lower LSM scale of the economy, you'll pay less tax or be exempt, and higher you go, you have custom at specific rates. Stop there, I might be going slightly. So tax on the extractive company. I've drawn here, I think what is an important slide for me when I'm thinking about corporate taxes, even though it's on the legal company, there are important elements that have to be considered in the context of corporate tax. Of course, a company, an extractive, will generate revenue from sales, and so you have the cash that comes in, and every one unit of cash that comes in has to be distributed broadly amongst the red bubbles that you see on the screen. So the shareholders are waiting for a return on investment. Labor will demand a salary. suppliers will demand payment and government will demand rates and taxes. I think, for purposes of the point that I made earlier, the reason that it's important that there is a balance in your tax system and that you have to consider the real incidence of tax is the bigger you make any one of these single bubbles, any one of the red bubbles, you have to correspondingly decrease one of the other ones. So if sales is constant and we increase corporate taxes unnecessarily, the biggest or the easiest place for a company to limit costs is on the labor side. And the moment that you reduce the income on the labor side, you will affect natural persons. And the biggest saving any given natural person can make in their own life is around housing. And so you will find that the bigger you increase the government bubble from a corporate tax, the less and less there is available for labor, the less and less, or the lower down people have to go on the housing scale. And so you find a direct effect on the property market. So it's important to remember that you can't just look at corporate tax in isolation. You have to appreciate that yes, the company might pay a specific amount of corporate tax on its profits, but there is also tax that is in your labor circle. So if some participants in a tax bracket where they can start generating sufficient personal income to pay their own taxes, and so you have a multiplier effect that tax has through the economy. If a company can pay good, honest suppliers well, they will in turn pay their taxes on their own profits. They will in turn have their own labor who can pay income tax. You will have value added taxes or goods and sales taxes on the supply element. And of course, if you can treat shareholders well and they get a proper return on investment, you have new money in wealth brackets that can go down and further development in a country. So I think, while we all are very happy to jump on the transfer pricing bandwagon, and please understand me, it is absolutely critical in the modern economy, I think we also sometimes have to just appreciate that there is an element of balance here where we can't so control and regulate what companies can charge each other, because ultimately it all does flow into a single, and it has to be shared amongst all of these.
Charlene, your sound is breaking up again.
Or extractive companies, as you may wish, are very. Is it better? Sorry, I can't see the screen, so
it sort of goes in and out, Charlene. Why don't you keep going, and I guess either Michael or I can interrupt you if we stop hearing you. The problem is that we can hear sometimes, and then it goes in and out of focus. Why don't you go ahead and pick it up, and if it's still a problem, I don't know, maybe you can call back in or something. But look, why don't you keep going? Let's see how it works.
Okay, please just ask me if there's a point that you want me to repeat.
I would just pick up where you are and keep going.
Okay. The taxation of mining entities is of course similar to other taxpayers. There is no, when you whittle it down, the product is different and the ultimate input is different, but really the running of the company is similar to most other taxpayers. Mining is mostly conducted through corporate entities. I think it's very rare to see other legal forms partake in the mining industry at the actual extractive level or the operating level. If we need to differentiate extractive industry for tax purposes, I think there are a number of considerations. Firstly, The level of capital involved in the extractive industry to set up a mine is enormous. And so it is an easy means for a country to attract offshore investment. You can't physically move your mine about around the world as it suits you. So it's a means for a country to ensure adequate offshore investment into its borders. Mining is highly immobile. Once you've sunk the hole, you've sunk it. And of course, the capital injection happens at the beginning, and investors have to wait quite a long time before they can ultimately see the rewards of their capital investment. And so once they're in, they're almost locked in for a minimum period of time. There are specific industry circumstances. Similar to forestry, there's a high initial cost of capital, and there is a long lead up from exploration and initial mine shafting to the production phase, where an entity can firstly start to make profits and then be taxed accordingly.
Charlene, there's a suggestion that you turn your video off. It might improve your audio content.
Okay, let me just
see if that helps. I think it's much improved over what it was in any event.
Is my screen still sharing?
Yeah, your screen is fine.
Okay, so the basic corporate structure I've laid out for you here. I think it's important to see this from these are the bigger mining houses, so not necessarily the smaller mines that might just operate domestically. This is looking at something like Rio Tinto or BHP or South 32, which of course none of this structure is not based on anyone in particular, but their structure should all broadly within the same parameters reflect something more or less like this. So you have at the very top an investor who can be onshore or offshore to the country that we're considering, who will pay in their own right income tax and corporate taxes if it's a corporate in relation to the income that they make. You may have an in-country holding company, which will similarly be subject to corporate tax. You may have further companies in the structure, and right at the bottom you will find the operating mining companies. They will be the main generators of the actual ore or the final saleable product. It's usual for these operating mines to have offshore marketing entities, and I think the easiest answer is to say that these offshore marketing entities are based in tax havens to save a little bit on corporate tax, but I think it's a more complex question than that. Offshore marketing entities, you'll find many in Singapore, many in the UK, and then some on the lesser islands. And the reason is one, yes, if you trap your sales in a low tax country, you might benefit a little bit from a transfer, well, you might benefit a lot from a transfer pricing perspective. But if I just take South Africa, where I'm from, as an easy example, we mine iron ore at the Sishen mine, which is situated in a very rural part of our country. If we are selling the iron ore mostly to customers in China, where we have an almost 11-hour time difference, what real engagement can we have with our purchases in relation to the iron ore that is shipped? So it makes a little sense to have a marketing entity close to the main hub of your customers. If you're selling gemstones, you might want to be close to the European markets where most of these stones may be traded, or you would like to be in the UK where a lot of trading around metals happens. So the decision around having an offshore marketing entity, though influenced by tax, is perhaps not driven by tax. There are strong commercial reasons why a mining group might choose to have offshore marketing entities in a different jurisdiction to where they operate. I think from a corporate tax perspective, it is important that we appreciate this diagram of taxpayers involved in the structure. Because if you have the operating mine in your country or in a country, and that is the main entity from which a country hopes to extract corporate taxes, it's also the main entity into which all of the costs will be poured. It is the entity that will physically dig or incur the costs to dig the hole, to extract the ore, who will pay salaries, all of those things. So you want that entity from a corporate tax perspective to be protected. And I think there is the influence of transfer pricing to say, if the operating entity is going to be taking the main operational risk and be bearing the main operational costs, it should also get the main cut of the ultimate profit when you've considered the whole legal entity as an economic whole. And its Singaporean sales office, who has three or four well-versed executives who can hop over to China and engage around the price of iron ore, that entity is not really taking a lot of risk, and so it shouldn't get the main benefit of the costing or the sales in the structure.
Yeah,
I just want
Shirley, there's a question in the chat box, which is really kind of a question that Michael addressed yesterday. I tried to talk about a little bit in management accounting, but the question is how can a tax administration efficiently track transfer pricing and the kind of structure you're talking about? It's kind of a fascinating question. I think what you're going to find in the management accounting sense that the marketing people have their own profitability that's determined in one fashion. The operating people at the mining level have another, so on and so forth. And then you try to split all that up between these legal entities. I don't know that you have a comment on that. Maybe Michael does, but
certainly. It is a very interesting question. I think from my perspective, and I've been tracking some of the work that ATAF is doing, there's a brilliant Zambian example around where I think understanding, firstly, it's the point that the gentleman made earlier in his question too, firstly understanding the pricing makes a big difference. If you can understand the supply chain and the costing between the operating mine and the offshore marketing entity, then and the global price at which a mineral might trade, it's easy for the indexed minerals, but some of the the minerals that aren't indexed, it's more difficult. But I think that for me, from a tax administration point of view, is the first and perhaps a very important part of the life cycle of an audit to finally understand where, as a revenue authority, you can start to unpick the structure. So if you can understand how the pricing works and then overlay that with how the corporate structure is, or what the corporate structure looks like, you're in a strong position to then say, well, that's really interesting that the operating mine is selling at a 1% margin, but in the final country in which the mineral is delivered, you have a 20% markup or a 20% net profit on this mineral. And I think you can use various tools within the company to determine that difference, but fundamentally understanding how it works is perhaps the most critical part.
I agree. Sort of a basic understanding, but if you're a tax authority in the country where the mine is, which would be the case of in many instances in Africa, you may not see what the profit margin is in the marketing entity in Singapore, let's say. That's one of the reasons that you have this country by country reporting, sharing of information. The degree of transparency helps enormously, I think.
Even though with a good deal of transparency and knowledge of how the company works, the key in the extractive sector is valuing the product as it comes out of the mine or or whatever this point of sale is at the producing country. And there are so many uncertainties in, even if there's an index price, in valuing a particular product from a particular field or mine, oil field or mine, that I think we too readily assume that simply having a good deal of information and transparency solves the transfer pricing problem. The problem is inherent in the uncertainty of pricing itself. And you know, after a long time in this field, I've come to view the transfer pricing problem as just not solvable. It's always going to be an area of friction. It's probably comprises an argument for trying the difficulty of transfer pricing. Probably comprises an argument for emphasizing in fiscal regimes a little bit more than in the past royalties as opposed to income taxes. I mean, there are certainly downsides to royalties, but when you start to try to estimate a mining company's, producing company's arm's length level of income, there are just inherent uncertainties. There is no really accurate way, really precise way to estimate a market price in the absence of a real market, and that's a problem that goes back to Adam Smith, and I think it's just one of the areas of friction that we'll always have to the extent we're trying to tax net income relative to gross revenue, which I realize is not a panacea in itself.
Yeah, but what if you took the profit for the business segment and then decided, I mean, that's a real figure, it's a hard figure. And then you decide how to try to split it up between the different functions and different jurisdictions.
Well, that's a formulary approach, which
well, it's not exactly it is in a sense. It's a sort of a transactional profit split approach, which is a form of formulary stuff, but that's an alternative as well.
Well, I personally think that the impossibility of transaction by transaction arm's length valuations makes that formulary or profit split approach, inevitable. And I've argued that for a long time. Although there's some, for the first time ever, really, there's some acceptance of that approach in the Pillar 1, OECD's Pillar 1, and we'll see where it goes. But so far, it hasn't. For people have been suggesting formulary approaches since at least the 1970s, and they haven't really garnered a lot of political support. And the other day you suggested I was taking a cynical view by suggesting that both taxpayers and governments likely uncertainty to some extent. It gives them more power and it gives them something to do in terms of spending a lot of resources and earning a lot of resources doing transfer pricing work. But I guess I'm not quite that as cynical as I just sounded, but I think there's something to it. There's something to it, the political attractiveness of this very unsatisfactory way of trying to price. It gives a lot of people interesting work.
Yeah.
Okay, back to you. We don't want to do your presentation, Shirley.
No, thank you. I think it's always an interesting debate, and to some extent, I do agree with Michael. I don't really know that it's a solvable problem. I think, the biggest win from a transfer pricing perspective is probably to get the very aggressive transfer pricing out of the system, because the risk from a revenue authority is probably somewhat shared by the taxpayer, because neither of them can accurately estimate future price or current price unless you have a buyer who's willing to pay. So yeah, but anyway, I think when we're talking about corporate tax, it's also quite important to appreciate the different levels or the different composition of income that each entity will have. So at the operating mine level, we've discussed the fact that it will earn revenue from the sales of minerals to its offshore marketing entity. There we can, and I think you probably will go into some detail in the transfer pricing section around the two different models at which that marketing can work, if it's a direct sales agent or, a sales agent, or if the entity takes legal risk. I think understanding the composition, is it earning a service fee, or is the marketing entity actually paying for and acquiring the mineral with full legal title and full legal risk? As you flow from your operating mine, eventually the income flows into the holding structure to the investor level. You will predominantly have passive forms of income such as dividends and interest, which of course can be legally taxed within the realm of corporate taxes. Most jurisdictions will allow for exempt dividends and somewhat exempt interest to flow through an economic unit, so a group of companies with a specified level of participation in one another. And the reason makes sense. You don't really want to meddle with the sort of passive income in that linear structure. You would probably seek to tax it heaviest at the investor level and beyond, so where it's returned on your listed markets or to the final holding structure being a trust or a family that sits behind the investor level. Okay. This is just a slide that perhaps sets out in a little bit more detail some of the thinking that we need to do when we're talking about the bigger structure of a multinational extractive and some of the corporate tax elements that might be relevant for each level. So of course, that there are two main forms of corporate taxation. You can have a source-based tax or a revenue, an income-based tax. So source-based tax simply looks at the source of the income, is or is it not earned within this specific legal jurisdiction, and if it is so earned, it is taxed within that entity. You find that is a tax system that is still is popular within the confines of the African continent. Many countries still have a source-based taxation. Administratively, it is a simpler form of tax administration. It doesn't involve complex structures to determine whether income is or isn't earned by a resident in your state. Sorry, that's the correct name: source-based and residence-based taxation. Residence-based taxation looks at every legal subject that is resident within the borders of a specific country, and it taxes them accordingly within a defined system of what it regards as income and taxable income, respectively. So a shareholder or the investor sitting at the very top of your structure might comprise resident or non-resident entities or legal subjects. How will you tax them if these are corporate entities? If it's a non-resident corporate entity, it's better from an overall income tax design system to levy a withholding tax. So if you think about interest and dividends withholding taxes, which still fall broadly within the confines of corporate taxes, or if it's a resident, do you prefer to tax those as corporate tax, as an income tax? Most tax systems will adhere to most corporate tax systems will adhere to the principle of equality of treatment between residents and non-residents. You want to tax your residents on the same effective tax rate as you tax your non-residents and vice versa. The reason is that you don't want to interfere with the participation in the local economy between residents and non-residents. So it's quite important to make sure that the corporate tax system flushes out broadly the same effective tax rate, however that might be composed between residents and non-residents. At the company level, you will have profit and you will seek to tax profit. And then you have to, again, understand the transaction flows. Is the main transactions with foreign entities, with local counterparties, You do find in some countries, from a corporate tax perspective, there is also domestic transfer pricing that regulates the price between legal subjects within the border, although most jurisdictions only have transfer pricing rules applicable cross-border. And then, of course, offshore entities. If you're using a source-based tax system for taxation of transactions with offshore entities, you might have a tax levied on services provided in country as an effective withholding tax from a corporate tax perspective. And then, of course, you finally have employees who may be residents or expatriates. So let's maybe delve into the, sorry, John, we have a 15-minute break scheduled shortly. Before I jump into this section, shall we take it?
Yeah, sure. This is a convenient time to do it. Why don't we do it now, and then we can come back. So we're at, I always have trouble with my time translating into other people's time. We're 8:30 here, so it is, I guess if it's 8:30 here, it must be what, 3:30? What time is it where you are, Charlene?
It's 1:30 where I am.
1:30, so it's
I think it's 3:30.
yeah, it must be
Nairobi.
3:30. In any event, it doesn't matter exactly the time. It's the time of the break. Why don't we reconvene? Why don't we say in instead of 1/4 at 10 of, how's that? 10 of the hour, we'll reconvene. So a little over 15 minutes.
Okay.
All right.
Perfect.
Okay, so we're taking a break until 10 of.
John, I'm ready when the team is.
Yeah, well, I think it's now 10 of, so we can begin. I just want to make one comment. I think we should leave some time at the end. We have 15 minutes for discussion, but maybe expand upon it a little bit. I think people might find it interesting if between yourself, Michael, and myself, and the people that are on the call or in the course, I'd like to give people a sense of how it is in a big company that sets transfer pricing policies and the interaction with the business unit. I think people may find that interesting, and I don't think I was that unusual in it. Maybe I was more outspoken than a lot of tax directors, but I had a seat at pretty senior levels in these companies, and there would be a rather engaging dialogue about where profits were reported, what units deserved what amount of income, and the interaction between the legal entity reporting and management accounting. I think people might find it quite interesting about how in practice those discussions take place. And it's not as though tax is sitting in a little cubby hole in the back office someplace and people come in and say, fill out the information in this form, please. Tax has had a much more central role in a lot of these companies in recent years than that image might convey. In any event, let's hold up some time to do that at the end of everything. Okay. Why don't you go ahead, Charlene?
Okay. So we have spoken about where tax fits into the broader legal structure, how we can tax, the different levels at which we can tax. So let's now maybe in the remainder of the discussion turn to tax at the actual company level and corporate tax specifically. So as I was explaining earlier, you can have a source state or a resident state or a resident worldwide means of taxation. Source taxation applies equally to residents or non-residents, and it's easier from a tax administration side to administer. Worldwide taxation taxes all residents within the boundaries, the legal boundaries of the specific jurisdiction, and usually you would test residency by looking at the incorporation or the legal seat of the company. And for corporate income tax purposes, we also look at the place of effective management. Have you physically incorporated a company in Mauritius, but for all intents and purposes, you are really operating the company within the borders of South Africa? If so, South Africa will regard that entity as being resident within its borders. You have a similar test for natural persons, but just looking at corporate tax, the place of effective management is quite an important principle. Place of effective management, there are varied tests around what the place of effective management is, but generally you would take the economic hub, the true heart and strategic mind of the company. Where does that happen? And where is that based? Some jurisdictions apply squarely. Where do the directors meet and greet, and where do they make their main decisions? I think that can be a bit arbitrary sometimes. It is easy for a bunch of executives to hop on a plane and fly to Mauritius and spend 2 days at the sea having a board meeting. For me, it would be more, I prefer the test that looks a little bit more at the strategic, the guiding mind. Where are your executives? Where does your CEO sit? Not just the sort of where the board meets from time to time. There may be other reasons why companies will incorporate in a different jurisdiction than their place of effective management. think many countries with very strict reserve bank or central bank restrictions and currency restrictions might prefer to incorporate in a different country to manage their risks pertaining to exchange controls or currency fluctuation or political risk, but would readily admit to having a place of effective management in a different country and will usually in that case accede to being taxed there. It is quite a complex test. It's not an easy test to do in practice. I think the principles and the amount of writing that the OECD has done on this point is extensive. So I think that it's an important point to understand from a corporate tax perspective. And of course, once you're in a situation where you have two different jurisdictions, you would have to overlay to the place of effective management test also the DTA provisions. Where does the DTA, which jurisdiction in terms of the double tax agreement effectively is entitled to apply its corporate tax regime to the legal entity? Turning in a permanent establishment is something different entirely. Of course, a permanent establishment is a taxable presence in a country. You find it readily in other types of industries, such as the insurance industry and so forth, where you can have a small office of agents who undertakes policy design perspective for extractive industries. You don't really tend to see many permanent establishments, although they do exist perhaps more readily on the marketing side than on the actual extractive side. And the reason is quite simple. Your business is highly immobile, so it doesn't make sense to argue that you don't have a taxable presence if you have a hole in the ground. So a permanent establishment is simply an arm of the business or a leg or a part of the business that's carried on in a different jurisdiction, but it is sufficiently big for a jurisdiction to seek to tax the income generated there. And again, you have a multitude of instruments to determine what the actual profit is that you would attribute to that entity. And you start getting into the realms of having created a legal fiction where you regard permanent establishments as somewhat separate legal entity from its parent or from its actual legal body. So you separate it slightly, attribute a profit margin to that entity and tax it accordingly for corporate tax purposes. A basic income tax calculation has these levels of taxation, as you have gross income, exempt income, which gives you income, then certain deductions and allowances, which give you taxable income. Taxable income is multiplied by a tax rate, and that will give you a tax liability. Some instances you have rebates against that actual tax liability. I think it's important to understand this from a revenue design perspective because it shows you the various levels that you have to regulate and that have to be thought through around both about giving incentives to attract foreign direct investment, but also the tax levers that you have to pull to make sure that the ultimate tax liability reflects the economic participation of that entity within the economy. Important here, I think, to distinguish between deductions and allowances. Usually deductions are for expenses that are directly relevant to the operational side of the business, such as salaries, paying suppliers for diesel or for shipment, paying trucks to be shipped to use for shipping purposes. Whereas allowances are a specific legal instrument where a revenue or a fiscal policy might admit to allowing certain expenses to be deducted, which might not otherwise be deductible. And many of what we would generally refer to as incentives in extractive industries sit as allowances, strictly speaking. And most jurisdictions or many jurisdictions offer in extractive industries this ability to deduct a disproportionate amount of capital expenditure against income for extractive taxpayers. And the reason is that you have this very long lead time from actually starting the exploration activities to, setting up the mine, starting to mine the ore. There's a significant time delay between that and actually earning the income. And the incentives for extractive industries mainly sit to increase the amount of deductions through allowances to reduce taxable income in those very early years of conducting business. The OECD research on incentives I actually find quite interesting, and some of the ATAF work as well. They don't seem to work as well as we think they do practically, and the experience or history is showing that taxpayers take a lot of advantage from these allowances and do generally pay no taxable income for a very, very long period of time, despite earning significant revenue from the sale of iron ore or from the sale of ore. Let me not focus on iron ore here. And that over time may lead to countries giving away too significant amount of taxable income that they may otherwise have taxed. And so you see increasingly this focus on removing incentives for the extractive industry, and also in some way saying they are similar to other taxpayers, and what they can, the advantages that they should get should be less. So you find globally that there is sort of a removal from the tax system in supporting foreign direct investment by giving proportionate allowances against income, because it does for corporate tax purposes. So when we look through that calculation in a different way, the ways that the levers that we have to control both the amount of tax that a taxpayer pays for corporate tax purposes, but also the relief that might be given in recognition of some of the unique characteristics of extractive industries. To stick with income, you can increase what is regarded or legally defined as exempt income, streams of income that are not worth taxing or are considered from a policy perspective not necessary to tax, or you can increase non-recognition. So what you would otherwise have included in the concept of income or gross income, you can by definition exclude, therefore either increasing or decreasing what a taxpayer would regard as income. You can toggle the definition of deductions. In the South African context, again, we have in the mining industry what is called an all-in status, which means that for gold mines, we don't distinguish between capital or revenue deductions. It's all deductible, whatever you incur. And that effectively reduces the effective tax rate of gold mines disproportionately to other taxpayers. I think the advantage to our economy is self-evident, but it is one means of toggling the definition of what is deductible. You can allow specific deductions of a capital nature by increasing specific provisions, and you can allow for past tax losses to be carried forward and to reduce the existing or the current amount of tax to be paid. Capital or allowances, you can find capital allowances. You find many of the extractive industries use capital allowances to offset against taxable income. So you have a separate calculation that says in relation to the following types of capital expenditure, we will allow you to deduct an amount up to a specific ceiling or up to the amount of taxable income that you have if we exclude all of these allowances. You can have accelerated capital allowances. An example here would be depreciation for accounting purposes. You have usually what is called wear and tear from a tax perspective, and you can accelerate the rate at which a taxpayer can recognize its wear and tear over time, thereby effectively giving a greater capital allowance. You can also have specific mining allowances that deal with specific types of capital expenses. You can reduce the rates of taxation or change the rate of taxation. Many jurisdictions have different rates of taxation that apply to the extractive industry. The next slide will show some of those things. You can have a sliding scale for tax rates as we do for personal income tax. or you can have deferred payment of taxes. So while the tax is triggered and legally recognized, now we defer payment of it to a later point in time. And then, of course, you can have rebates for specific industries. So we've spoken through tax at the shareholder level, but maybe just to make sure that we've thought through it, you can have at the investor level, investors usually earn passive income, dividends, interest, and when they realize their investment capital. If the investor is a corporate entity, what is the corporate tax rate that applies to capital realization? Do you have capital gains tax? Are gains taxed from that perspective? I think, as an example, Namibia does not have a big capital gains regime, and so if you realize a capital gain as a non-resident, it's unlikely that you will be taxed. You might wish to have incentives to unlock private wealth, and you might wish to attract this from resident or non-resident investors, and your tax system or your tax policy can support attracting that wealth. I think importantly and increasingly relevant, you do want participation from local communities. So you have, in most countries or in most developing countries, you have a requirement that some of the wealth generated from the mine should be shared with the local communities at a shareholder level, so at an investor level, or at least as an investor into the operating company level, because that really is to give them a sense. Mining is a one-way street. Once the mine has been depleted, there will be no future income for a community that supports a mine. And so it does make sense to use your tax system to give incentives around participation for local communities. And of course, the impact of double tax agreements at the shareholder level is very relevant. If we look at what some countries are doing, just to spread around, the different types of corporate tax, the different types of corporate rates, it's interesting to compare the Australian and Canadian examples to some of the other states. There aren't many, or there isn't necessarily a lot of variation, but interesting to just see what countries regard as the example of Namibia, where they have where they are strong in diamonds, to see the toggling the tax rate there in relation to that industry. Okay.
I don't know whether anybody has a question about their own jurisdiction here or not, but if you do, now's the time to raise it.
Also, just looking at the Canadian and Australian examples, and this is done using IBFD data. Interesting to see that they don't have specific mining taxes, whereas the balance of the jurisdictions do seem to have them. I thought that was quite an interesting point of differentiation, using two sophisticated developed markets versus a couple of not having them.
It's sort of interesting in tax loss carry forwards that most of the countries have perpetual, and there's not all of them, obviously some limits in some of these countries, but it's been a forever argument in the US. Can you take a loss and carry it back? And I don't see that being a provision here. Maybe it is in some cases, but okay. So question one is, can you take a loss back and offset it against prior income taxes paid and get a refund? And if you can carry it forward, for how long? And it's interesting that we see perpetual in many cases here, which has not been the case in the US for sure.
May I ask a question?
Yes, please.
Yes, what usually in terms of tax losses, I've seen them being carried forward for a period of time, like 5 years, 7 years. What would be the reasoning for allowing perpetual carry forward? What was he thinking?
I think so let me talk to the South African example. So our regime has just been reviewed, and it is currently being changed from perpetual to non-perpetual to a limited carry forward. my sense is that as companies have become more successful, the perpetual loss carry forward is regarded as a harmful tax practice for revenue authorities. It's an older, at least from my perspective, it's an older regime. So it used to be more relevant, but taxpayers have become so sophisticated in how they manage their tax affairs that they're just becoming increasingly able to create a perpetual loss to perpetually carry forward. The thinking that supported the ability to carry forward a tax loss is that in essence, as the company grows and the profits increase, that loss should be eroded over time. But taxpayers keep thinking of ways to let it stay alive. And our revenue authority is becoming increasingly concerned, especially where you have new investors and the ability to use debt instruments to aggravate the loss or to increase the loss that can be carried forward. You may find that taxpayers who formerly paid tax and had nice taxable income, they contributed to the fiscus regularly, suddenly stop. And so the perpetual loss carry forward does create, I think, a bit of volatility. It's also not just limited in terms of time that can be carried forward, but also the amount. So from a South African perspective, we're now moving away from the ability of a past tax loss being able to offset the entire taxable income. It can offset an amount, it can offset up to a ceiling amount, and thereafter taxpayers should pay a minimum amount of tax. And I think it is somewhat reasonable to say that this tax planning is creating significant volatility at the fiscal level, and so should be somewhat mitigated by changing the rules.
Yeah, I think another thing is just simply the mechanics of it. If you allow perpetual, suddenly you're looking at years far in the past, and the ability to really audit those years may be quite limited in the carry forward period. I mean, 10 years in the past, who knows what the records are? It may not have been audited very carefully in the year of the loss, because the tax authority said, well, there's a loss. We're not going to spend a lot of time on that. And if you allow it to be carried forward for 10 years, and when it's being used, suddenly you say, wait a minute, we didn't even look at that year very closely. So there's some practical aspects to it as well. And so I'm surprised, frankly, to see perpetual in these countries. Okay, forging ahead.
I thought this was also quite just an interesting slide to see what the effective tax rates are over life of mine. Some interesting countries that sit at the top of the list: Ivory Coast and Uzbekistan. And I mean, I'm not sure about the extent of extractive industry in Sweden, but it sits at the bottom. And of course, it's not holistic, but just an interesting point to say that the ideal range is regarded as between 40 and 50%. And it does seem like a big portion of the bell curve distribution does sit there, but some interesting examples at the bottom and the top. If you look at Zimbabwe, interesting examples. So tax planning, what is it? What should it be, and how do we look at that? So I think, firstly, when we're conducting or planning, or when you look at an extractive company, it's important to remember that tax is ultimately a business cost. It is a cost that the shareholders have to bear, or that the company has to bear on behalf of the shareholders. So it's not necessarily an evil thing. Also, to distinguish between tax planning, which is optimizing tax as a business cost, against evasion, which is illegal, and avoidance, which is the lawful utilization of a tax system to manifest a tax advantage. Evasion, it's the criminal side of tax, involving fraud, misrepresentation, or intentional non-disclosure. It is, in most jurisdictions, tax evasion is a crime, and one can understand that from a fiscal or administration costs, from revenue administration costs, this fraudulent activities create a whole lot of work for really little gain. Avoidance is anticipating a tax liability which has not necessarily manifested and taking active steps to avoid that liability. There are some legislative protections that are generic to most jurisdictions, but you do find over time that some jurisdictions do not have them. The one is substance over form, which is taxpayers might undertake specific types of transactions to obtain a specific tax advantage that would not have been available to them had they actually acted or transacted in accordance with the legal substance of what they're doing. So they've undertaken a transaction which in form will give them a specific tax result, but in substance they've done something completely different. Here, if you think about exiting shareholders, a repurchase of shares, which will give you a specific dividend, which is usually taxed in a more friendly way, versus a sale of shares, which is usually taxed at capital gains tax rates. For corporate entities, you might find some entities try and undertake a repurchase. In substance, they've sold their shares, but in reality, or in form, they've done it slightly differently. We do have general anti-avoidance provisions and specific anti-avoidance provisions, which I think most jurisdictions should have. General anti-avoidance provisions would just be a generic set of rules that would apply to all transactions, whereas specific anti-avoidance provisions would apply in the context of specific types of transactions or specific types of taxpayers. This was a slide that I referred to earlier. If you look at the taxes, the business costs, and what taxpayers plan, this was a UN survey conducted by the Chamber of Mines and was submitted to a tax committee in South Africa. And I thought it was quite interesting to see what taxpayers think about when they think about tax and when they plan for tax. So you'll see both elements talk to tax certainty that I mentioned at the outset. I think it's quite important to know that, from a revenue authority point of view, to appreciate that the way that you apply the tax system and the stability of that tax regime, the ability of taxpayers to predict and to cost tax over time, is not the first and the only thing that they look at, but it does sit on the list, and both speak to certainty. I think in Africa we find, at least from an advisory perspective, the main reason that taxpayers do not wish to go into countries is they can't firstly accurately predict the way that they will be taxed, and so they can't predict the returns on investments that they will have over time, and thus can't source capital or allocate capital to invest. And secondly, if your revenue authority can show up tomorrow and close your business for 3 days while it's decided you need to be audited, and you have no means, once the audit findings have been released, you have no means of properly challenging those through a stable legal system, taxpayers will walk away. So I think those, while we shouldn't negate the importance of a stable and well-informed tax authority, the ability that, or the difference that can make in a taxpayer's decision to invest. And consequently, you want people to invest in companies that will, in the extractive industries in the country, they provide a source of labor, they provide tax revenue in various forms, they provide salaries, and many of these companies also do a lot of public good in country. So I think it's important to also appreciate that aspect of tax, of corporate tax. Tax planning, as I said before, it's the efficient allocation of capital resources, utilizing a legislative framework to reduce your overall tax burden. And it's the difference between adapting a plan to pay taxes efficiently or to change a plan because you have an opportunity to avoid paying a tax. I think all of us, if you invest on the stock exchange in the extractive sector, you don't really want the company to pay more tax than it should. No one wants to run the economy in that way. You want a company to pay just the right amount of tax. It's required to do so without necessarily aggressively planning to avoid that. And I think that the disclosure content that John went through from an IFRS or from an accounting perspective is quite important here. And you find increasingly, at least the big corporates are recognizing in this new ESG world that the tax is also a social tool. One of the Professor Willem Jacobs, who used to be on the board of one of the big mining houses in South Africa, I attended a talk that he gave, and he raised the concept of tax fairness versus tax smartness. Is it a taxpayer who is seen to be and acts to be super clever about their taxes and to actively take steps to pay as little amount of tax? If that comes into the court of public opinion, consumers now have a choice, and Labour has a choice around where it wishes to work. And so that tax cleverness is losing a lot of its attractiveness, especially in the extractive industries, where you're heavily reliant on having good public relations with the host communities of the mine. And tax fairness. Sorry?
Yeah, I was going to say something. Go ahead and finish your thought, and I wanted to make a comment afterwards.
Sure. Tax fairness is looking at your tax affairs and planning them appropriately and correctly as a business cost and responsibly, but also in recognition that you don't need to necessarily take advantage of every single possible means of reducing your taxes. And in the extractive industry, I think that's absolutely critical to make sure that, as an entity who's there for a short lifespan and the ultimate existence of a country who will only be there for a short period of time, paying tax in recognition of what you're taking and paying those taxes fairly and honestly should form the baseline of all of your tax policies. Yes, John.
I was going to say this has been an enormous debate that you can probably go way back in time on the issue. And the question really is part of a broader question, which is, in managing a company, is your only concern the return to the shareholders, or is it a broader concern for the community? And does one marry the broader concern for the community and say over time that actually rebounds to the benefit of the shareholders as well? And you see that as a broad sort of issue. And frankly, in the recent years, it's sort of shifted towards a broader concern of the community. But in the tax world, I saw behavior that it was not illegal per se, but it was extraordinarily aggressive. And say to the people involved, well, what in the world are you doing? And they would say, we owe our duty to our shareholders, and this is legal, so we're going to go ahead and do it. And there's a pretty broad swath of territory between what's clearly illegal and what is acceptable. And different people have different views on that. But it's kind of an interesting tension, and I don't think it's going to go away anytime soon. And so that's part of the B team type of thing versus people that feel that the shareholders are paramount and we should push as hard as we can to reduce our taxes. Enough said.
Yeah, agreed. I've included some extracts from South African courts around what they regard as the difference. And I think some of the commentary is interesting to read, and these are all corporate taxes, so they're relevant. The taxpayer is entitled to be astute to prevent, as far as he honestly can, the depletion of his means by revenue. what is what is the difference between a good citizen and a bad citizen? And then a general discussion point. I think that is always key to remember. And in the break, I did look at some of the chats. I think the importance of a strong revenue agency is perhaps the first port of call, and the complexity of the fiscal policy that underscores the tax system should match the ability of the revenue authority to meet those demands. I think a strong revenue authority with a set of simple but clear laws can do much more than a weak revenue authority with the best laws in the world. There's a lot of research around corporate tax in this context in the extractive industry generated by ATAF and OECD, and they're unanimous in their confirmation that a proper revenue generation is based as one of 2 points on the revenue authority. So, well-empowered, well-equipped revenue authorities only be a boon to any corporate tax regime and any corporate tax environment. And I think going back to the tax planning from a taxpayer point of view, if they have a revenue authority with which they can engage openly, honestly, who will assess them fairly and give them a means to appeal an assessment that they feel does not suit or isn't based on the correct understanding, that provides an economic hub for everyone to grow. And I think the research from ATAF or the documents released by ATAF is that they're specifically focusing on training and upskilling revenue collection agencies in Africa. And if you're more interested in this, a lot of what they've published, I can share that with you. It's public, the success that they've had in Zambia by just changing 1 or 2 things. I think those are absolutely critical to understand and to learn and grow from. I think tax transparency and transparency on the taxpayer point is 1/2 of the equation. I think tax administration and revenue authority transparency and stability is perhaps a discussion that is often missed. And maybe in the virtual world, we can think more laterally around how we can marry what's already available in the industry and how we can increase training and upskilling at the revenue authorities. Here is the case study. I'll share the ATAF paper with you, but let's speak through it quickly. I know, John, you said we should reserve more time, so please stop me if you think I'm running over.
Okay. Yeah, keep going by all means.
So Zambia has the listed extractive minerals available to it, and the revenue generation for Zambia is key, and it's a key determinant of future economic growth. It's important from a Zambian perspective that the appropriate revenue is generated to alleviate fiscal pressures from increasing government expenditure and debt. It's a bit of a success story for the 3 agencies, the IGF, which is the Intergovernmental Framework, I think, and ATAF and OECD, that improved the methodology to value manganese ore. It was streamlined, so they created a framework where valuation was streamlined at export. So let's just say for excise duty purposes and for customs duty purposes, they streamlined the way that it was valued, and that valuation was reported at the point of export. As a result of that, there were fewer tax disputes with the taxpayer. Building on that, they could then revise the transfer pricing rules to prevent base erosion and profit shifting by considering the use of hub structures. So once you know the price at which, or the value at which the taxpayer is exporting, you can benchmark that, or you can use that against the value that is reported at the point of sale in the hub structure. Understanding the appropriate benchmarking for sales prices and volume traded, which I think we've discussed earlier, around the point that these are very difficult to use as a direct metric, but at least understanding is a beginning. and to ensure the appropriate revenue is generated across the direct and indirect tax types. Which I think is quite an easy one. If you're reporting different values for goods and services taxes, corporate taxes, and for excise and customs duties, why? What is the reason for the difference? Because theoretically, at least, you're selling the same thing for all three. So all of those should be the same. And one shouldn't just focus on transfer pricing in the corporate tax space. If you can adequately get a range of market value in the transfer pricing world, that should be extrapolated to indirect taxes as well. And then I think an easier one is increased support for audit cases. In this case, ATAF actually supported the Zambian Revenue Authority in undertaking the audits, but this probably is a manpower issue. I think I shared with you this South African tax case, which is for us at least the first of its kind. It involved Sasol Oil, which is a South African multinational who trades in oil and petroleum-related products, and it concerned international shipping and sale of crude oil. I think it's quite an interesting case to read around substance over form and around the complexity of some of these marketing and distribution agreements, which I think, to a point that someone raised earlier, it's very complex to understand these structures and to how they work. Ultimately, the distribution entity was based in the Isle of Man, and it was around the transactions between two related parties. And the SARS, the South African Revenue Authority, attacked the structure on two grounds. It said, firstly, that there is a substance over form issue, that the distribution agent in the Isle of Man does not take any legal risk in relation to the oil it ships. So, was it a shipper? Did it actually just arrange shipping? And what was the overall purpose of the entity? Did it actually take legal risk? Why should it trap all the profits when really it's just making sure that the ship arrives at port on both ends? And the other test was a general anti-avoidance test around the sole or main purpose of the transactions. Was the sole or main purpose of the overall regime to obfuscate any tax that might otherwise have been due? So if we follow the legal structure of the entity over time, or the entities involved, you can see that you begin with Sasol International Oil Holdings in South Africa and Sasol Oil. And then you have the Middle Eastern crude oil shippers who sell directly to Sasol Oil in South Africa. And as Sasol becomes more complex, and of course from a South African point of view, as the global markets opened up to South Africa around that time, Sasol then incorporates two entities offshore in Isle of Man and London. At the time, I think the business justification for incorporating these entities in those locations was that the UK is quite close to the international markets and the main market on which crude oil is traded. You then have, over time, the sale from the crude oil shippers to the Isle of Man company back to South Africa. So again, what is the purpose of the interposition of this Isle of Man company? Why does it need to be part of the structure? What is the commercial or the business benefit to this entity being involved? Again, another evolution. We now have, between South Africa and the crude oil shippers, two entities with back-to-back sale agreements. What is the purpose of each of those entities? Why does there need to be an agreement between STI and Sasol? I think it makes sense because the ship will still go from the Middle East to the port in South Africa. It doesn't first stop at the Isle of, sail around South Africa or through the Suez Canal to the Isle of Man and then to the United Kingdom and back to South Africa. The crude oil is still coming directly from the Middle East to South Africa. Again, another change where they incorporated a third company offshore, and now you have the removal of one of the former companies. In the sales structure or the supply chain. What is the purpose of it? Why does it need to be there? Ultimately, our revenue authority considered the SOIL entity as unnecessary, and the arrangement between it and SISL as being a form of as being differently classified under our substance over form rules. But it's nonetheless an interesting example, an interesting case to read from a tax perspective to understand how you would apply or attempt to apply general anti-avoidance rules to a multinational in the extractives industry, and some of the commercial justification and the tax planning around having these interposed entities and the shipping arrangements between them.
Yeah, let me ask you a question about this. So the South African point of view was that the oil that was coming in, it was refined in South Africa then and then sold locally. What happened to the crude?
It's refined in South Africa at port, at one of our ports. Sasol has a facility there where it refines the crude oil and then on sells both into South Africa and I think offshore.
And so the issue is the price artificially high so that the profits from refining and distribution in South Africa are too low? Is that the sort of the hub of the case? Or the
it wasn't a transfer pricing attack, quite interestingly. It was around so it's not necessarily the price that was applied. It's about the need for the multitude of legal entities that are involved and the risk and reward that all of them held. So I think what our revenue authority tried to do is to say that in substance, what you've done is these entities only acted as agents to arrange the shipping. They didn't take legal title and therefore should not. Your intention was never for them to take legal title, and therefore the substance of the form of the legal agreements does not tie up to the actual legal substance, which is to deliver crude oil from the Middle East to South Africa.
Yeah, but from a tax point of view, what's the bottom line? If you take these entities out of the equation, what then happens tax-wise in South Africa? How do you get more income in South Africa?
So our revenue authority said that the sale should be repriced as if it only happened between South Africa and one of these legal entities, so that you take out the margin that was earned by the other one and attribute that back to South Africa for taxation here.
Okay, so the margin in both the Isle of Man and London companies would then end up in South Africa, is that it?
Yes, because the substance of the agreement, so under our law, a court can collapse the form and re-engineer the arrangement in accordance with what it regards as the legal substance. So if the legal substance was a sale between South Africa and the Middle East, I think what they said is that the price at which Sasol Oil acquired the crude oil was excessive, given that the margins earned so that the price that it was charged by its own subsidiaries does not reflect the legal substance of what those subsidiaries do.
Okay, so what happened then in the case?
We can talk through that. So the case ultimately said that it's not, they didn't consider the general anti-avoidance rules. They reclassified the arrangement between Sasol Oil and SOIL to be a direct sale between those entities, to say that the shipping, they're going to ignore the shipping to SISL. There was in law, that is not the substance of that sale was not necessarily reflective of what the ultimate intention of the parties was. Because I think ultimately the Isle of Man entity, the SOIL entity, did take some legal risk, and it was entitled to some legal reward as a result, but the SISL entity was not.
Okay. When was the case decided?
It's fairly recent. Let me just check with you. Check for you. It was heard in 2017.
Yeah.
And reported in 2018.
No, it's an interesting case in terms of interposing entities. You know, part of the whole BEPS project is to strip out some of the stuff.
Exactly.
Okay. Where are we, Charlene? Do you have more that you want to cover? Or
No, I'm done.
Okay, well, thank you very much. Folks, I don't know, Michael, do you have any questions or comments? Let's open it up to the group, and then I wanted to talk a little bit just from a practical point of view, my experience about how these big companies work. But before I get into that, let's open it up. So I don't know, Michael, do you have a comment or question you wanted to make?
I just would comment on the discussion in the chat about the Westminster case from 1936 in the UK. You know, there are similar language in a famous United States Supreme Court opinion from about the same era, Gregory versus Helvering, which basically says that it's inevitable that if there's a line in the law, if there's a line in the tax law, taxpayers will, by virtue of competition with one another to have the lowest tax rates permissible, go right up to that line, and that it's not realistic to expect taxpayers to pay more than they think they are required to pay under the law, which places a big premium on easily discernible and understandable lines in the law. It puts a big premium on lawmakers to produce clear laws that can, so the taxpayers know what the right answer is. And I keep harking back to this, but the antithesis of a clear law where you come up with easily discernible answers to what you're permitted and not permitted to do is transfer pricing. And so I think it's inevitable because of the lack of clarity or lack of predictability of the transfer pricing laws, the great difficulty in valuing, say, mineral product, even if you have posted mineral prices, that we run into problems and conflicts and a feeling among some that the companies are not acting properly, but that they're overdoing it and acting overly aggressively. I think we really need to focus much more on the clarity of the law than we do on the intention of the taxpayer. If the law is not clear, the taxpayer really doesn't know what its intention should be.
What do people think? Anybody else have an opinion they want to share on this?
I agree with Michael in the sense that since the law allows you, you're free to do whatever the law allows you to do. So we should focus more on the clarity of the law and on the boundaries imposed by the law. It's more certain for everyone involved, I think.
Let me pose an example, real life example for people, and I'd love to hear what people have to say about it. So one of the planning techniques that these tech companies and other companies, I don't want to just blame tech companies, employed an Irish company structure, which has now been changed. But the way it worked was this: you would have a company in Ireland, incorporated in Ireland, which had a relatively low tax rate, but the company would then have an office, permanent establishment, if you would, in Bermuda, let's say, or some other tax haven. And arguably, that office there managed the operations of whatever the Irish company was engaged in. And so from an Irish tax point of view, your tax liability depended not where you were incorporated, but where you were managed. And so despite the fact you had an Irish company resident in Ireland in a sense of a legal entity. From an Irish point of view, it was managed and resident tax-wise in Bermuda. From a US point of view, everything evolved or looked at where the company was legally present. So you can see in this structure that from an Irish point of view, if you put your income into Bermuda, it wasn't subject to tax in Bermuda, and it wasn't subject to tax in Ireland either. On the other hand, from a US point of view, it was all being earned by this Irish company. It had a zero tax rate, but back under the old law in the US, if you didn't repatriate that money back to the US, there was no US tax on it. And so that was the structure that was in common usage. It was being sold by the big accounting firms, and I gather probably by some law firms too. It was entirely legal, but there were some ethical concerns about it. So how do people feel about that? What if you were in charge of a company, forget whether you were the tax officer or not, if you were in charge of a company, would you think this was appropriate for the company to do?
Let me interrupt, John, just to mention that this tax structure was very heavily reported in the press, which led to a lot of the current BEPS work at the OECD. But the tax structure was called the double Irish. And it sounded like you were ordering a double shot of Irish whiskey at a bar. And also part of the structure involves setting up a Dutch entity to stand between the Irish entity and the rest of the group. And that part of the structure was called the Dutch sandwich. So the press reports on all this sounded like a menu in a restaurant.
I will say that the the CEO of Apple, Tim Cook, was called before Congress to testify about this structure. But how do people think about this? This was the kind of stuff that was heavily in use for many, many years, at least amongst US multinationals, and I venture to say some multinationals from other countries as well. And it permitted these US multinationals on their foreign income to report extraordinarily low tax rates. So does anybody want to make a comment on this before we move on?
Lynette has a hand. Lynette Eastman has a hand up.
Yes,
okay.
I saw that John mentioned the accounting firms, I guess, and the law firms. That's what I was going to make my comment on, because there are a number of parties involved in this. There are governments, there are MNEs, there are the professionals, there's the community that we spoke about, and then you have the issue as to whether or not these are moral questions. Now, I would imagine with a multinational corporation, if they're going to engage in a new, say, for example, because Barbados is actually auctioning off some blocks at the moment. So suppose there's a multinational that's interested, and essentially what they're going to do is they're going to go to their accountants and their lawyers, and the question is going to be, what is the optimum way to structure my investment in a particular country? And this is what the professionals do. This is what they do all day long. So they're going to come up with the best solution. I think the only thing then that they would probably say is to advise them of the risk involved and the likelihood of success with respect to the particular structure. Now, if you're a CEO of a multinational corporation, I think after going through that, you're paying these people to advise you. Then for you to say, oh, I feel kind of concerned morally. that isn't what the CEO was hired for. The CEO, I think, would take the best advice possible, decide on the risk, and make a decision about that. The truth is, none of these things are being done in secret. The revenue authorities know, the governments know. The governments have an option to amend legislation, go to Parliament, amend legislation, and they've done that in the past in order to prevent some of these structures from existing. The courts, all they can do is look at the law as it is there, but the Parliament has the right to change it at whatever point. So the company may decide in terms of dealing with their community responsibility to develop programs out of their profits. But I think it's going to be a very difficult thing for a CEO with, top-notch accounting and legal advice to go against it, except if there's a significant risk involved, or the chances of success at the end of the day, whether or not it is worth it to engage in the particular enterprise. So, that's how I see it. For me, there's little that's moral about tax at all. So that's how I see it.
Okay, fair enough. Other comments? People have different views? All right. I thought I would, we have a few minutes. I thought maybe I would give people a flavor of how a lot of the tax world works in these big companies. Some of you, I'm sure, have been worked internally in a big company and have a good sense of it, but some of you probably don't have that. So I thought I'd talk about it a little bit, and if people have questions or comments, we can go into that as well. But in any event, I was internally at a number of large companies, and was head of tax at one and head of tax planning at another one. So I pretty good appreciation of it. I thought I'd start with the players. Who are the players that get involved? I mean, obviously you have the tax people, but usually you also have, in these large companies, you have the corporate controllers, and the controllers are up and down the line. Each subsidiary, at least each one of any size, has a controller. And then the business unit will have a controller. So you have corporate controllers on a legal entity basis, and you also have corporate controllers on a management accounting basis. So there are two groups of corporate controllers, and they worry about the corporate controllers on the business entity basis, worry about the financial accounts, so to speak. The corporate controllers or accountants, however you want to term them, on management account, worry about the management accounting. So that's one group of people that get involved. Usually there's a treasury input as well. A lot of these entities have to be funded in some fashion, whether it be capital or debt or some mix of the two. And the treasury people will be involved. At one of the big companies, I was head with a treasury person of the actual transfer pricing for treasury purposes. And then you have obviously the business management group that run the businesses involved, or the business in the particular legal entity. You have them, and you have the tax people. And typically the transfer pricing people are in the tax department. Not invariably, sometimes some of the controllers also have transfer pricing people. Usually it's kind of a mix, mainly with the tax department, some in the controllers area as well. And then finally you have top management. Now, top management doesn't get involved day by day. but typically they do get involved in tax policy. They worry about the effective tax rate. They worry about the processes that's involved. And they will set some priorities about how important tax planning is. If they think it's important, then the management accounting will be done after tax. And that drives business behavior in a huge fashion. So those are kind of the players involved. And then I thought, even though I'm hardly an expert on mining, my background's more in finance and large financial institutions, but in mining, just based on what I do know, you're going to have production people, you're going to have marketing people, you're going to have funding people, you're going to have head office people. And those people are, it's not just, oh, well, let somebody in the tax department determine this by itself. The controllers are going to worry about it. So let's take the case where you have a intermediate company that performs a marketing function, is going to buy, let's say it's iron ore, and then resell it to somebody else, maybe resell it internally up the chain, but presumably at some point it reaches a third party. And that company, wherever it's located, but presumably in some cases in a low tax jurisdiction, has some kind of management function there. And the marketing people, wherever they sit, they may not, and probably don't even sit in that subsidiary. They probably sit at a regional headquarters or in the company headquarters someplace. So now you look at the structure, and the people that are doing the planning sit down and say, okay, how do we price the iron ore coming out of this company where the production's taking place? Let's say it's in Liberia, that produces iron ore. And this iron ore is going to be sold ostensibly to a company in Bermuda, and then it's going to be on-sold. How do we price that product, and how much profit is left in Bermuda, and how much profit then goes on to the headquarters company? How do we compensate the marketing people that are in headquarters? And how do we do this from a legal entity versus a management accounting point of view? How much of the profit belongs to the production team? How much of the profit belongs to the marketing team? How much overhead or how much of senior management? What's the proper fee that those people should get? And so there's a fairly intense discussion on these things. And it's not as though the tax people say, well, we're going to do it this way. The controllers get into it. They say, I have to prepare financial accounts for this entity. And your pricing is crazy. I don't agree with that whatsoever. And there can be some fairly tense standoffs on a lot of these different issues. And it's not as though that this is all laid out and the tax people control the world, or for that matter, that they're irrelevant. There is quite a dialogue that takes place. And before a result is reached. And if you go back to this sort of double iris structure we were talking about, I can tell you that the use of those structures reached high up into the company level. There was undoubtedly a debate whether the structure was appropriate. It may have reached the board, it may not have reached the board, but it certainly reached all the way up to the CEO at some point. And the CFO of the organization was involved. And my guess is they went to an outside firm, both a law firm and an accounting firm, and said, what do you think? Should we be able to do this? Does it make sense? Is it good corporate policy? So all these issues that we've been talking about in a broad sort of social sense involve multiple players in these large companies, working on a problem and trying to reach some kind of solution that they feel is proper. And some of them have different interests or and different perspectives on it. So it's kind of an interesting thing. It's not just that this sort of emerges unscathed and in some pristine form without much debate. It actually internally is typically subject to a lot of analysis and debate, and and the articulation of it is probably set pursuant to some broad corporate guidance as well. So I offer that up. I don't know, Michael, you've had some experience with this as well. Other people love to hear your comments on it, but the problems are when you get down to the human beings making the decisions, they're kind of interesting to think about.
Well, the double Irish was a kind of hub company structure. And of course, in the extractives field, we use marketing hubs all the time. And the question, and we shift income to those marketing hubs by claiming that those marketing hubs provide economic value to the value chain. And there are typically the internal discussions about these structures will focus on whether if you can really honestly say that the marketing hub is doing something. Typically the product doesn't actually get physically ever touch the shores of the marketing hub jurisdiction. The product is sold directly from the mine or the well to the customer. And sometimes, there's also a question, do you need to have actually some people resident in Bermuda who are doing marketing in order to justify this? Or can you simply say that there's flash title passing in Bermuda with nothing actually happening in Bermuda, with all the work on behalf of the Bermuda entity being done back within the headquarters company in Europe or somewhere? One of the hardest parts of dealing in corporate taxation is what is honest? When can you honestly say that that hub company is doing something to justify the income that it receives? And that's where a lot of the agonizing happens in corporate boardrooms and in tax departments around the world. Another point is that once a few big players do a particular structure and decide that you need 3 people in Bermuda or whatever the answer is, that tends to take over the industry. So there have to be a few pioneer companies that do a particular tax reduction scheme, and then after a few have done it, that becomes the standard for the legal and accounting firms around the world. And it's a very messy process. It's one where as John was saying, there's a great deal of agonizing going on among companies and among their advisors. And I think I think a lot of it's driven by the inability to make firm conclusions on transfer pricing matters. I think it's the lack of an ability to find what the standard really is makes this a much harder area and a much less socially desirable area of life than it might otherwise be. And I'm not sure what the solution is, but I think clearly a big part of the solution is getting more definite laws, and laws with more certain laws and finer lines in the law.
Also, Michael, I think to a certain degree, you can also legislate only so much. Otherwise, you end up with reams and reams of pages of legislation that are only applicable to certain very, very specific facts, and you need a team of 100 people on any given transaction. So I think there is also something to say for having less specific laws and taking a more purposive approach, which perhaps does sort of go back to the point that you then have to understand the intention of both the legislature and the taxpayer. But to have some room to maneuver on both sides isn't always a bad thing. And being an advisor to many of these companies, ultimately what they ask me as well is, if this was on the Sunday paper front page, what would be my risk, because there is also a risk to the entity and its reputation. And we've seen at the investor level, many of these are listed companies at the investor level, what the effect of such a stunt can have on the share price. Many of the sovereign funds who are invested at the listed level are also taking a very negative view and will actively disinvest if they understand that the corporate that this is the way in which a particular entity conducts its affairs. So I think there is also a balance in the system when you look at it overall. I don't necessarily think you have advisors peddling nefarious schemes and the taxpayer see an advantage to pay something. I think that may have been at a point, but we've evolved now. Sorry, I do see in the chat box that I think Lynette wants to ask a question about PE.
Yeah, Lynette has a question about something different, but before we move off this and on to Lynette's question about PEs and Pillar 1, do other people have a question they'd like, or a comment they'd like to make about what we've been talking about? Okay, Lynette had a question about PEs and Pillar 1. So why don't you go ahead, Lynette?
Okay, thanks. We were talking about Pillar 1 yesterday, and the fact that there's a certain threshold that you have to meet. My understanding was that there was really only a handful of companies that actually qualified under this regime. So if a multinational corporation actually does qualify, and for that type of taxation where taxes would be imposed based on consumption, and the multinational has let's say a permanent establishment, which is what it would be, using the double taxation agreements, which would be management, advertising, but they have an office in the jurisdiction, which will be unable to tax the MNE under Pillar 1. Is that jurisdiction then, under the new regime, do they go back to the rules under the double taxation agreement in order to tax the PE in their jurisdiction? I guess the broader question then is, and I don't know if this is being worked out, how do the double taxation agreements in existence work along with Pillar 1?
Well, we could probably give a whole course on this, Lynette, but in a quick answer, and Michael can also comment on this. Pillar 1, first of all, to implement it, contemplates a multilateral instrument, and in other words, some kind of a tax agreement that would override existing tax treaties. So that is designed to overcome the existing rules and double tax treaties that might call for a different result. There is an issue about how you integrate local taxes that are due because the company who's already has a permanent establishment in a jurisdiction, or alternatively, under Amount B, will be paying some tax in the jurisdiction, even if it hadn't before. How do you take into account those taxes and offset them or carve them out from the tax that's imposed under Amount A, sort of the allocation, the marketing allocation distribution function? And in the latest go around that the OECD issued, there were a formula there. And some of the formulas, frankly, were more complicated than probably needed to be in the paper. But there was an attempt to create some kind of articulation of a formula that would take into account existing taxes and subtract them from the amount that was due, the tax due on amount A. But it gets to be quite a complicated subject, and one that would require a lot more time than the few minutes we have here to answer. I don't know, Michael, did you want to expand on that at all?
Well, no, just a general observation. I'm sorry, I think I may still be muted here. Yeah, just a general observation that Pillar 1 will require an implementing treaty. There are lots of areas in which Pillar 1 would contradict the language of the typical bilateral tax treaty. And so if Pillar 1 is adopted, it will require a treaty, a multilateral treaty among participants.
Okay, does anybody, I want to spend just a minute on what we're doing tomorrow. But does anybody have a final comment or question I'd like to ask about what we covered today? Okay. Charlene, thank you again very much for your presentation. I think everybody enjoyed it. I know I did. So thank you very much. Tomorrow, we're going to be joined by one of Charlene's colleagues at Weber Wenzel. And we're going to talk about, to begin with, investment contracts and some things having to do with them, a little more about double tax agreements, tax treaties. And then we're going to spend a good part of the time about dispute, way tax disputes are handled, resolved, or hopefully resolved tomorrow. So that covers tomorrow. And it should be fascinating, the subject. And I'd like to thank all the participants for being here today. I thought we had a very good discussion. I don't know, Michael, did you want to add any comment?
I just wanted to add a special thanks to you, John, and to Charlene for some excellent presentations today. This was a provocative and in discussion-inducing set of lectures, and they were excellent. Thank you.
Okay. Thanks, everybody, and we'll see you